was a very good morning from him, and of course it's certainly a very good morning from me. Hope you are welcome to my mortgage live stream. So hope all is good. Hope you're enjoying the summer and all the things that bring goodness to your world in the mortgage sector. Lots of things happening, of course. And we've got a couple of great topics for you as well to help you with your CeMAP studies, your CPD, or whatever it is you're looking to do. We're all good here, thank you. Thank you for asking. I hope everything is fine for you as well. So today I've got a little session for you on higher lending charges. It was mentioned at the spending review last week by Rachel, our Chancellor, because she's looking to confirming that they're making it permanent, the UK government's high lending charges. It's going to be made permanent, and we'll come on to that in a second when we look at the topic for you. And I've got a little sales idea to help you to run a business, more effectively, to make sure that you've always got that steady flow of business coming your way. So without any further ado, let's pop over to our whiteboard where we can get on with our first session today for you. Here we go. Now, the first session today is the subject of higher lending charges. Now, the thing about higher lending charges is we have to go back into history for this, and they don't tend to operate so much nowadays either, so we need to be aware of that. So what is a higher lending charge, first of all? Well, back in the day, and I'm talking here about the 80s, 90s and early 2000s, banks and building societies were always willing to lend long at a high value of the property. So if we have a property, which, just draw a little picture there of our little house there for you. And the property itself, of course, allows the lender to lend long. And lending for 20, 25, 30 years is long, of course. Now, to be able to take out a mortgage on that property, you want to make sure that the customer pays it back, of course. But also, if they don't pay it back, you want to be able to repossess that property and sell it on the market and then pay off the mortgage. And that's always been the worry for lenders when they've been asked to lend high loan to values. Now, a high loan to value, ideally, is around about 75%. And that, of course, is your loan to value, as we call it, LTV. Now, what that means is if you're going to lend below 75%, then there's plenty of equity in that property. So even if the price of the house comes down and the mortgage goes up, when you flog it to repossess, you're going to pay off your mortgage. But over the years, lenders have been encouraged, or the market has demanded, that they lend more and more. And nowadays, of course, you can get 100% mortgages from some lenders, and most, of course, are 95%, 90% lending. So back in the day, what lenders would do is they would say, okay, well, we'll lend you more than this basic figure here, this 75%, for example. But what we're going to do is we're going to buy a policy. And they used to go on the market, and from an insurance company, so that might be, L&G or whoever, they would buy this policy. And they called this policy a MIG, a mortgage indemnity policy. Mortgage indemnity guarantee policy. It was an insurance policy for any other circumstances. But what the policy did is it covered the lender against the borrower defaulting. So let's just put a couple of borrowers down here showing our little picture. There's your little borrowers who, of course, are taking out the mortgage to buy this house. And they're going to pay the mortgage and everybody will be happy. But what the lender would do is that any amount above this basic figure that they used to have to whatever these people are borrowing, they would take out insurance for that. So let's take an example. Say, for example, this young couple wanted to borrow 95%, say, of this property value, whatever the value is. And just put a few numbers in there for you. Let's say the house is worth 100,000, just because it's easy to work on that figure. Not that you can get many houses for £100,000 anymore. So the difference between what the lender would normally lend, 75%, and anything above what they're wanting to borrow, 95%, is the amount of money they want to insure for. And as you can probably appreciate, that's £20,000, isn't it, in total there? So the difference between the two is 20 grand. There we go. So you've got £100,000 property, 95% is what the customer wants to borrow, which is 95,000. 75,000 is the basic advance, as they would call that. That was the phrase they use, basic advance. And anything over the basic advance, the lender would want to insure that for. So what they would do, they'd go to the insurance company and they would take out a policy for £20,000. That would be the value of the policy. And to pay for that policy, there was a premium involved, and the premium was very expensive. The premiums were tiered percentages. Let's put in there tiered percentages. Tiered percentages according to the amount that the customer is borrowing. So the premium for this was the tier percentage. The higher the loan to value the customer was wanting to borrow, the more expensive the premium was. And the lower the loan to value, right down to 75%, of course, the lower the premium, because obviously it's less risk. And for example, this might have been, e.g., 10%. So £20,000 at 10% is what, a couple of £1,000. That would have been the premium that would have to be paid. Now the borrower would have to pay the premium, and they would pay that to the lender, and the lender would then pay the premium to the insurance company, and hence we had the policy. Now we've got the policy, a mortgage indemnity guarantee policy. What would happen then is if the lender had to repossess the property and sell it, and say, for example, the price of the house had come down, and maybe the mortgage account had gone up, and there was a shortfall, then the lender would claim against the insurance company, who would then pay out the shortfall based upon the maximum that they had. They would always do usually sort of 20% excess is what they used to do. What this means is that they would pay out the amount of money to the lender less 20%. That was like a car insurance as an excess. And that's how it worked. Was it a good thing? Yes, it was. It worked really well because it meant that lenders could lend high percentages to these young couples, and they were protecting themselves with additional security through purchasing this mortgage indemnity policy from an insurance company. If they had to claim, the insurance company would pay it as well. A couple of things came out from this, though, that you'd be aware of. There was this thing called subrogation. Still is, of course, subrogation, which you might find as a question. In a nutshell, what would happen is if the lender repossessed the property, tried to sell it, and they made less for the house than they wanted to, they went to the insurance company and made a claim for the shortfall that they had on their mortgage account. The insurance company would then pay the money less the excess. But then the insurance company, under the rules of insurance, would then go to the borrower and say, look, you caused this problem, guys, because you didn't pay your payment. So we want that money back from you. Well, please, can we have it back? And that used to be called subrogation. Of course, these people couldn't afford it because they just had their house repossessed anyway. So invariably, they let them off. But that's the rule of subrogation. So what happened to mortgage indemnity guarantee policies? Well, they were very popular in the 80s, the 90s, the early noughties. And then the financial crash came along and they died a death, because insurance companies just were unwilling to lend this sort of thing to a property market that had collapsed pretty much in 2008, 2009. So they stopped doing them. So insurance companies stopped actually issuing these things. So you couldn't actually buy MIGs anymore. Obviously, the CeMAP syllabus still includes it. So then, of course, you found a situation when lenders in around 2009 or so, they were in a bit of a pickle because no longer could they lend high loan to values. Yeah, just put that in there for you. No longer could they lend high loan to values because they couldn't buy these insurances anymore. So lenders stopped doing it. So the maximum mortgage you could get for a number of years was about 75% loan to value. 2009, 2010, 2011, it was impossible to get a mortgage without a decent deposit. You couldn't get 95%, 100% mortgages for many, many years. Lenders started to do it, but what they would do instead is they would merely just charge a much higher interest rate. And now what they tend to do is if somebody's borrowing a high percentage of the property, they'll just charge them an extra interest, because they do. And that extra interest they put aside in their capital account, if you like, to pay in case of problems in the future. That's how they tend to have worked it. However, the UK government stepped in a few years ago and created the UK Mortgage Guarantee Scheme. So rather than the insurance companies over here, there you go, offering them, the UK government decided to do it. There you go. And this came in 2021, I think it was. There was a typical scheme before that as well. The Labour government has said they're going to keep it going. So invariably, they'll probably keep going for forever now, which allows the lender to go to the UK government to take out a similar policy, and the lender has to pay the UK government a fee for that guarantee, if you like. They don't charge the borrower for this, they just charge extra interest to the borrower, and that extra interest they pay the government the fee. But essentially the UK government are providing this mortgage indemnity guarantee, the same sort of concept really when it comes to it. As far as the rules are concerned with MCOBs, if there is a higher lending charge involved, then naturally that has to be shown in the KFI or the ESIS, whatever you're issuing there. So any cost to the high lending charge needs to be disclosed to the customer. And by the way, the customer did have, the premium that they had to pay £2,000 or so was allowed to be added to the mortgage, which is ironic, wasn't it? A 95% mortgage plus a £2,000 higher lending charge. So it could have been added to the mortgage as well, which is something that they used to operate. But now there's no fee involved, you see. The lender just charges a high interest rate and pays the UK government. Or the lender decides, we're just going to take a risk on this and lend high percentages anyway. And some are doing that now. Your April mortgages, your Skiptons, a lot of them are doing high percentages. Yes, they're charging higher interest rate to the borrower, but they're being really careful as to who they lend to. And also careful with the property to make sure the property's in good nick as well, because it's a risk. Remember, the lender takes a risk because they're lending long, and they're lending a lot of money on the basis of the security of the property and the person's ability to repay. Now, in the exam, you'll get a number of questions, probably, because they still do. I don't know why, but they just do. So what I want to do is just share with you a couple of example questions, see what you think about these. So let's give you a question then on the exam, just to sort of give you an idea of what comes up. Here's a typical question that you might get, and we'll take you through this one. When Fred bought his £80,000 house using cash of £6,400 and a mortgage for the balance, his lender charged an indemnity guarantee premium on the excess of 75%. If the rates were 4, 6 and 8, how much was the premium? So this is a very typical big question. And what I would always do with this one, and I'll bring it back up again for you, what I always do with this one is I will always draw my picture of my house, because I just do. That's how I work here. But there's your house. Now, if you go back to the question, which I've got it written down here, the house costs 80,000. There you go, 80 grand. And Fred's got cash of £6,400 deposit, and he wants a mortgage for the difference. So the mortgage that Fred wants, £80,000, less 6,400 is 73,600. So the loan is 73,600 pounds. That's how much loan Fred needs. Now we can work out some percentages. Now the lender will charge an insurance guarantee on the excess of 75%. Typically 75 is the basic advance. So remember my example earlier. So £80,000 times 75% is 60 grand. Let's just put this down here for you. So 60,000 is 75% of the value of the property. And you've got premiums there as well. You've got 4%, 6%, 8%. So first of all, the amount of the indemnity guarantee policy is going to be the difference between the basic and what Fred wants to borrow. And that happens to be 13,000. Let's put that over here for you. £13,600. That's the amount of money that Fred wants to borrow, 13,600, between the basic advance, 75%, and what he wants to borrow. And that's great, that's 13,600, but we need to work out a premium. And the premium is based upon the loan to value that Fred wants. And Fred's on 73,600. That's a loan to value of 92%. Let's put that in there. That's a 92% lending, isn't it? Now, go back to the question. They gave us a number of figures here, didn't they, for the rates? You've got 4%, 4%, 6 or 8, depending on the loan to value. Now, Fred's loan to value is 92%, so it fits in quite nicely there. Between 90 and 95%, the lender will charge 6% to work out a premium. So what you then do is you do 13 times 6%, which gives you the premium. So you just want to work that one out. 13,600 times 6% gives me £816. £816, and that should give us one of the answers, which it does. D, £816, which is pretty good, isn't it? Now, that's an example of a very big calculation question. You get different examples in the exam as well. I'll give you one more example just because I think you're enjoying these, aren't you? So let's give you another example of a typical question. This one involves a mortgage. Let's pop down there. Mortgage indemnity guarantee would be required for a loan of 100,000 on a property valued at 120 when the lender offers 75% the valuation. All you're doing with that one is you just need to know how much is the mortgage indemnity guarantee policy amount. And you've got a couple of figures there, haven't you? You've got your £100,000 loan, property valued at 120, and the lender offers 75% the valuation. So that's the figure as well. So what you do there is you grab your calculator. Property is valued at 120,000. So 75% of that gives me £90,000, as you can see there. And this person wants to borrow 100,000. So the difference between 90 and 100 is 10,000, which is A. So A is the right answer on this one. You just need to work it out. You could have done a picture as well if you wanted to on that one to make it easier to work it. Just very quickly, if we popped across here, quickly put that in there for you. You can see how quickly this is to do if you do a picture, which I would always do. So again, just draw a picture of a house because it's a bit silly really, isn't it? Now for this question then, you've got a loan of 100 on a property valued at 120. So the property is valued at £120,000 and the customer wants to borrow 100,000. There you go. Now the basic advance for this one is 75%. So 75% of 120 is £90,000. There you go. So £90,000 is the amount of money above that, remember, the lender will charge the mortgage indemnity. So the difference between the two is £10,000. And that's the answer to the question. So it's just another variation of the type of question, really. One more for you, because I know you're enjoying these. This is a true or false question, really. Which one of the following is false in relation to mortgage indemnity guarantees? So one of these phrases or one of these statements is false, which is what it's about, isn't it? So if we take a look at these then, let's go through each one, see which one's false. A, they are a single premium insurance policy. Well, that's correct. B, the borrower is protected in the event of default. Well, that's the one that's wrong. We'll come back to that. C, they are paid for by the mortgagor. The mortgagor, by the way, is the borrower. The premium can often be added to the loan, which is correct as well. So the incorrect statement there is the borrower is protected in the event of default, because it's the lender that's protected in the event of default. So there's another example for you of a question on mortgage indemnities. And that ended the topic. Hope you found that useful. Bye. Well done, well done, well done. Okay, so that's a nice little topic there for you, isn't it, to get you up to speed with mortgage indemnities. But of course, the government have made a lot of changes to that now as well, particularly with the extending the UK government's mortgage indemnity. A bit like in the US, they have Fannie Mae and the Freddie Mac, which are not real names, but they're names for government banks that provide mortgage securities. So we'll do a video on that in a couple of weeks' time, just to sort of get yourself comfortable with that. But let's finish off then with our little sales idea, our little sales tip for you to help you along the way. Now this one's called 60%, 20%, 20%. Now I call it 60% perform, 20% progress, and 20% prospect. So what does this all mean? Well, the percentages are the amount of time you ought to spend on this area of your business as a proportion of your working life. Do this and you'll have a successful business. Now, of course, the path of least resistance is to drop the 20%, because you become really busy performing your job and you decide you have no time for anything else. So let's explain these percentages a bit more. Progress, by the way, and that's 60%, is the time spent progressing your knowledge, skills, and capability through self-development and learning. It's known as sharpening the saw. Prospecting is doing everything to fill your business funnel, marketing and bringing new clients into your practice. Now, many advisors seem not to enjoy this side of the job. Lots of rejection, you see, and humans don't like rejection. We were taught that as children and bounce away from it. Performing is doing the job selling and advising, managing your business, the enjoyable part, the piece that earns your daily bread. So keep to the 60-20-20 and you won't go far wrong. Drop the 20% at your peril. Believe me, I've been running my business for almost 25 years and I've experienced the pain of losing these in favour of performing. It's a pain I don't want to have ever again, and nor do you. Hope that's been a nice little update there for you as well. Okay, let's wrap up the live stream, shall we? Because it's time to go. As always, here's our database if you're interested in coming on to this one. So let's just put the database sign up so you can see that one. Here we go. Here's the database sign up for you to head over to that QR code, get onto our database. A lot of things going on this summer, a lot of changes happening to CeMAP and syllabuses and things like that. So we're going to keep you informed of what's going on because that's what we always like to do, don't we, along the way. Other than that, I'm going to wish you a fantastic week ahead of you. No live stream next week because we've got... well, actually, I will do a live stream next week, I think. And then the following week, we won't be doing one. I'm going to see my dad in France. So we'll be seeing you next week. Have a fantastic week, everybody. And we'll see you soon. Bye for now.